Private market investments, including credit, real estate, and infrastructure, are starting to play a bigger role in investor portfolios, especially as markets remain volatile. Investors look for new ways to diversify and manage risk. My next guest says there are plenty of opportunities to be found in the space, but that it's important for investors to do their homework. Joining us now is Colin Lynch from TD Asset Management. It is always lovely to have you here.
Well, thanks for having me. Great to be here.
It's great to have you here. I want to talk a bit about private market investments, because I think a term that's used a lot is alternative investments.
Yes.
And private markets are a sub-part of alternatives. Is that correct?
Yeah, that's right. That is really the space where you have access to commercial real estate or infrastructure or the private credit space, private debt, or the commercial mortgages space. That's really what we mean by private markets. And I think it's really accurate to what we actually do, which is acquire generationally attractive opportunities that are not publicly traded.
I think the key word there is probably generational opportunities, because for a lot of retail investors, I mean, there are places you can access it now. But I mean, these types of investments have been around for a very long time for institutional investors. Maybe just give a bit of history on what exists and now how the retail investor has a little more access to it.
Absolutely. When you really think about some of these investments, they have been around for as long as we've had civilizations. We've lived in buildings. We have moved our goods from one place to another using rivers. And how did they get onto the river? Through a port. When we have looked to borrow things, we need to acquire something or we need to get the funds together, we have, go back thousands of years, gone to somebody to provide that credit. So whether it's private credit, whether it's infrastructure, whether it's real estate, it's been around for as long as we've had civilizations. However, fast forward now thousands of years, these assets have been largely in two hands. One, the public hand, i.e. governments, and the other, large institutional investors. Increasingly. So you can think the very large pensions, sovereign wealth funds. What's interesting today is now we are effectively seeing a democratization of access to some of these really interesting, long-standing investment opportunities that have traditionally only been in the hands of institutions or in governments.
It isn't, and we'll talk a bit about that, because it is important for people to understand, what they are and the risk, and to make sure you can match the timing of what you want to do with what those investments are. One I know we've talked about a lot, especially probably more during COVID, was commercial real estate, which is part of that private side. And the focus for the longest time was on offices and how offices were vacant during COVID. But that has changed, has it not?
Yes, absolutely. The story for a long time had been how offices were dead. And there was real questions around, do offices have a future? Important to recognize two caveats to that. One was, it was a this part of the world conversation. So it was a Canada, a US, to a degree the UK, to a degree Australia. Not really as much in Germany or in Japan, one part. Other part was it was a size of city conversation. Bigger the city, the worse the commute, more difficult to access the office. So therefore, the office physical presence was lower. Now fast forward. We've got return to office mandates brought to you by big institutions, financial services, whether it's governments, et cetera. And we are now seeing the physical return of employees to the office, and we are seeing leasing as a result. And some of that leasing is happening ahead of the actual physical return. And so today, office is not dead. The highest quality office is actually seeing the quickest recovery, and that's consistent with previous cycles. And what do I mean by highest quality? Best located, tends to be a little bit newer, and great sustainability features. And so we're seeing the lowest vacancy there, the highest rise in rental rates, and that's beginning now to spill over in some of the lower quality office. It's not 2019 yet, important to know, but it's certainly much better in the office space than where we were in 2023.
Yeah, and I guess it goes back down to when you talk about the importance of active management and asset selection and the due diligence that's done with your team and others is it's finding those high quality that are resilient through these types of cycles.
That's right.
Canada also getting ready to enter a new phase on the infrastructure front. I guess, trying to counter the perhaps the lack of business that might be coming from the States with our own infrastructure build. On the surface, that seems very exciting. Is it exciting from your perspective?
Oh, it's very, very exciting for many reasons. Number one, these assets in the infrastructure space, really essential. If we don't have power, we have issues. If we don't have transportation, we have issues. And so we feel it as members of society when they're not available. So that's key for, are they really essential? Number two is the public purse is stretched. And so we have infrastructure renewal, that costs money. We have infrastructure growth because we have population growth, that costs money. Layer on technology. So we're in the fourth industrial revolution, technological age, digital age, AI. All of that means radical growth in the energy demand construct. So all that is in the demand for infrastructure from consumers. Then if you think about investors, again, this has been a place where historically governments provided everything, whether it was from hospitals all the way through airports, it was government provided. Now, there are opportunities for investors to have access to these assets. And so we're seeing significant growth in investor demand for these assets, because when you think about an overall portfolio, they interact a little bit differently than the stocks and the bonds. And so not only can you get the potential for returns, but also because they behave differently in a portfolio, you have the potential to reduce your volatility of the portfolio. And so you layer out now on top of that the need for governments to invest in their economies because of evolving geopolitical dynamics, and you almost supercharge the infrastructure demand that we are seeing. And so excited because certainly the last 10 years have been great for the infrastructure asset class, and we anticipate that will continue.
Can you talk a bit about, when you talk about the diversification in terms of, not moving with stocks and bonds, that's the entire, you want something that's different. Timelines are different.
Yes.
Risks are different.
Yes.
So how do you as an investor, think about this if you're starting to consider this type of thing for your portfolio?
Yeah, so there's a few elements to that. Number one, at the foundation, is this asset really essential? And that's not just the overall asset class, but not every asset within, for instance, a real estate context is as essential. Ditto for the infrastructure. So why does that matter? It is the reliability, consistency, and resiliency of the income. At the end of the day, a lot of the value, you can argue most of the value, comes from that point, the income generation potential of the portfolio. Okay, the other piece is around how does that asset perform when there are shocks?
And there have been lately.
There have been shocks. And there are different types. So you can have a shock in the public equities market. You can also have a recession. And you can have a shock without the recession, or you can have both. So then the question is, how is that asset going to perform when there's a shock? And that really depends on what does that revenue profile of the asset look like. So if you have let's say a power generation facility, and you have a contract with the government for 50 years, that's going to be a bit more stable than a different type of asset, which relies on, let's say, planes landing and the number of planes that are paying the airport.
Right.
So that's what I mean. Within the asset classes, you have different levels of resiliency. And so if you have a portfolio that is now comprised of a lot of the first type of asset, where you have reliability regardless of what happens in an economic expansion or contraction, that means that the impact on your portfolio might be a bit less than other assets that are what we call GDP linked, which move a lot more closer to the function of the economy. Net, irrespective of A or B, your portfolio should see a volatility reduction, but you can amplify that portfolio volatility reduction depending on what aspect of whether it's infrastructure or real estate or even the credit markets that you're invested in.
All right. You were talking about just some of the opportunities and how resilient income is, whether it's GDP linked or not, and the growth. But I guess the liquidity of the instruments themselves is also interesting. We saw, I've lost track exactly when, but I know when AI kind of, the AI is eating all the software kind of narrative comes out, and you saw some software stocks taking a bit of a tumble, and then the debt attached to those software stocks, people had some real concern about. How do you manage that? Like, because that's the private market, and as people are tiptoeing in, they're like, oh, I don't like that.
Great question. I'll give you a super short answer, but I could spend 2 hours on it. Number one has to appreciate that these are privately traded versus publicly traded. And so if you're talking about a large asset like a big commercial building or an operating company, by definition, it will take longer to buy or sell that asset. So the notion that one can achieve immediate liquidity out of the private markets, regardless of what it is, I would say is a bit optimistic.
Right.
So that's the first point. Second point is the best liquidity are for the highest quality things. If you just think about it, if you have the highest quality house or the highest quality location.
They're the most in demand.
Exactly. And that goes for up cycles and down cycles. And so one of the temptations is to go search for the highest yield without recognizing perhaps that those higher yielding things may perform not as well in a down cycle and therefore be not as liquid in a down cycle. And so it's really important to look at precisely what you're investing in from a risk perspective to ensure that you're fully aware that the higher yield opportunities may be great opportunities in an upcycle, but may present some liquidity challenges in a down cycle.
Yes, yield equals risk. I mean, that's those things too. Actually, maybe we can stick with the, sorry, just to back up then, it's important people think about timelines. Like this is not stuff that is ready to be liquid in a moment. Like
That's right.
You need to be thoughtful about where you're putting this.
Yeah, and you really should look at your personal dynamic and your cash flow needs.
Yeah.
Generally, putting more than half of your investments in the private markets is a stretch.
Yeah.
Largely because things happen in people's lives, et cetera, and having access to that liquidity is important for most people.
Yeah.
And even if you look at the biggest investors in the world, the ones that have more than half of their portfolio in the private markets largely have inflows of cash that are coming through on a contractual basis that they can rely on that. So for most investors, somewhere between 10 and 30% is where generally you can accomplish that portfolio risk reduction with some attractive income, but nevertheless keeping access to liquidity overall.
Yeah, and that's going to just depend on people too. As I say, figure out your own risk, what you're comfortable with. When you talk about yield, and you mentioned yield, I mean, obviously high yield's very attractive. People like to see the cash coming in. When you think about even commercial mortgages, which fall into that world, what do you need to be careful of, I guess, is what I'm asking.
Yeah, and the yield, I can understand it's really attractive. You can look back over the last 3, 4, 5 years and say, wow, this instrument gave me this very high yield. And most people stop there. And I would just encourage folks to look a little bit deeper. So really understand what is being held. And when I say that, are the mortgages, the loan to value, are they very high or very low? There's a metric called debt service coverage ratio. The higher that ratio, the more likely that asset will perform and the mortgage will perform if there are challenges. I would also look at the security. So if the borrower doesn't pay, what is the recourse? Is it nothing? Or is the lender able to have security with other things that borrower may have? Mm-hmm. Those are 3 questions that I would encourage folks to look at an overall portfolio level when they make investments, and then at the biggest positions in whatever vehicle they're looking at. Rather than just say, oh, wow, that's a great yield. Just recognize that the world changes, surprises happen, and one has to not just look at what happens in the great periods, but also when there are periods of distress.
What are, and I apologize, this is not a nice question to ask you this way, but 30 seconds left. What are you most excited about in the private space? What is something emerging that you think there's some interesting opportunities?
We have tremendous high-quality assets right across the spectrum. Debt, equity, infrastructure, real estate, that produce great income and are essential. And the excitement for me is these assets have typically not been available for retail investors. And so these high quality assets, the ability to invest in them in essential assets makes me very, very excited overall for investors.